Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand insight, strategies and tips to help you master the game of building wealth. And in this episode, I'd like to share with you a stepping stone strategy for buying your dream home. So obviously, it just totally relates to buying a principal place of residence, an owner-occupied property rather than an investment property. Now, there's lots of really positive growth predictions for the property market. The most recent one I saw last night was 20% over the next 2 years. That is, prices will rise 20% over the next 2 years. And so if these predictions turn out to be true and prices do rise significantly over the next couple of years, it means more people will be priced out of their desired location. So what might be affordable today could quickly become unaffordable tomorrow, as prices can rise pretty quickly and spasmodically, by the way. So it's not uncommon for a new price point to be reached over a one weekend, from one weekend to the next. And the same property now costs $50,000 or even $100,000 more. The reality is that sometimes it's just not possible to buy your dream home in one fell swoop, but a stepping stone strategy could help you get there. Now, the first important point I'd like to make is that buying your dream home has always been a struggle. You're just better off to embrace it rather than get anxious about it. Property has always seemed expensive. I bought my first property about 23 years ago for $150,000, and it was a big deal. It was a financial stretch for me at the time. In my early 20s, it was a dump that needed renovating. It was in a location that I didn't really foresee myself living there for a long period of time. It was a stepping stone. Getting onto the property ladder and buying your dream home will take a lot of work for a lot of people. Sometimes a bit of sacrifice, a little bit of hustling perhaps, but that's always been the case, and we're better off to focus on the solutions rather than the problems. The media will continue to write about how housing affordability is a problem, just like it was 23 years ago when I bought my first property. It is what it is. So the first thing you need to realize is if you want to get into your dream home, you really need to focus on building your equity position. That is the amount of deposit, either in cash or the equity that you have in other property. So if you're income rich but asset poor, the amount of equity you have will be a strong dictator or influencer to your overall borrowing capacity. So that equity could come, as I said, in the form of cash savings or deposit or equity in existing property. Now, if you're the reverse, if your earning capacity is rather limited, then accumulating more equity means that you need to borrow less. And so therefore you're closer to getting into your dream home. Either way, it's all about building equity and building equity as fast as possible. Now, a stepping stone strategy involves buying an owner-occupied property with the sole aim of accumulating as much equity as possible, as quickly as possible. Then selling that property, using that equity to upgrade to a superior property, and continuing to do that until you're in your desired location. So of course it takes a little bit of compromise along the way, but a stepping stone strategy has always been a very effective strategy to ultimately building your asset position over the long run. And I'm talking about sort of over the next 10 or 20 years. So there's kind of 3 steps to implementing a stepping stone strategy. Look, the first one is you've got to pick an attractive location with good short-term growth prospects. So buying a property in a location that is popular, that's currently enjoying rising prices, will create a lot of momentum and do a lot of the heavy lifting for you. So finding that location is key. Now, when investing, and really everything I've written about property investing is all about finding locations that are going to have the key fundamentals to drive perpetual capital growth. Well, this strategy is different because all we're really focused on is trying to get as much equity as quickly as possible. So therefore, what we really want to form a view on is an areas or locations shorter term growth prospects. So if you're comparing two suburbs and one has a better shorter term prospect but fundamentally weaker, that will probably make a better solution or provide a better solution for a stepping stone strategy than the one with the sound fundamentals. Typically, locations that are gentrifying will exhibit above average growth rates. So gentrification tends to have similar sort of themes, such as changing demographics. So you might get sort of younger double income professional families moving in where it used to be just either a very family location or an older demographic. The increase in renovating activity typically demonstrates that people are willing to invest in the area and that prices are moving forward. New infrastructure or amenities that enhance the community feel, kind of livability of a location. There's some of the common themes that you should look for in locations that are likely to have good short-term price momentum. Of course, we don't want to buy at the peak of the market either. We don't want to buy into an area where there's probably not as much scope for prices to rise. But at the same time, we don't want to take the risk of picking the next growth suburb either. And the reason is obviously you could be wrong. So if you pick a suburb that currently has very little growth, but you think it's about to take off, if you're wrong, your whole strategy is ruined. So you really want to pick a suburb where there is evidence of rising prices and rising demand, but where there's still enough scope for prices to rise sooner. So that's step one, is finding the right location. Step two is then buying an older style house with scope to manufacture equity. So often but not always, it's better to buy a house than, say, a townhouse, a villa unit or apartment. And there's a couple of reasons for that. Firstly, houses tend to have proportionately more land value, and obviously the land value is what's going to drive prices higher, or at least the value of that asset higher. And secondly, houses tend to offer more scope to improve their overall value. So you can renovate bathrooms and kitchens, landscaping, for example, add value. Adding a bedroom or living area onto a smaller home can have a significant impact on its overall value. And this is what people call manufacturing equity. Something that you can do to improve the value of a property after you've purchased it, which is really important. Now, older houses, say those built sort of pre-1970s, particularly 1950s, 60s, 70s houses, offer better opportunities than newer ones because they tend to have greater scope to make improvements, such as I mentioned, adding an additional bedroom can be really good. Adding living areas or making it more open plan will make it, more modern in terms of floor plan and flow and so forth. But of course, that can be structural, and if you really stick to mainly just cosmetic improvements rather than structural changes, there's less scope for cost overruns or cost blowouts. It's also important that the improvements that you make, the finished product, is aimed at the typical buyer for that location. So it doesn't have to appeal to your tastes, for example. It just has to appeal to the wider buyer, the wider market in that location. So build something that's commensurate with other stock that's around. Remember, it's not your forever home. All you're trying to do is maximize the amount of equity. Of course, it's a well-documented fact that locations close to the CBD, not in the CBD, but suburbs closer to the CBD, tend to provide better long-term growth prospects. And that's just really because of the supply-demand issue. So really, the process to identify the right location is to really start with a blue chip location and then keep moving out to adjoining suburbs until you find a location that meets your budget. That you can find the suburb as close to the city as possible that allows you to afford to buy a house. Subdividing property, so constructing a second dwelling on a property and subdividing it and selling off can be a good strategy. Of course, it's higher risk, particularly if you don't have experience. And remember, risk comes from not knowing what you're doing. So just be careful, and it's really important to get some tax advice. So the first step is identify the location. The next step is to focus on buying an older style house that you can manufacture equity in. And the third step is then to occupy that property so that you can avoid paying for capital gains tax. Obviously, buying, renovating and selling property is not a costless exercise. You pay stamp duty when you buy and agent fees when you sell. The last thing you want to do is make a donation to the ATO that's also going to eat into your financial gains. So therefore, you can nominate this property as your main residence. It will be exempt from capital gains tax. It might be difficult to occupy the property for the entire period, especially if you're completing some significant renovations, but that shouldn't prevent you from continuing to claim it as your main residence as long as you don't occupy another property that you own. So you either go and rent or live with family during that period. But avoiding the capital gains tax consequences means that any gains you make will be tax-free, and ultimately that's how you're going to build wealth. So in summary, buy a house that's located in a suburb that's growing in popularity, that has, upward price momentum, as close to the CBD as your budget will allow. Select the property that has the greatest scope to add value, so manufacture equity. Hold it for 2 to 7 years, but as short as possible, before selling and then moving closer to your desired location. And what you might end up doing is just moving a suburb closer and closer and closer to the city until you get to your dream location. Of course, this stepping stone strategy is not without risk. So if you're not prepared to do the research and really spend a lot of time on making sure you implement this strategy in as safest way as possible, then I say don't try and implement it. It's going to take a bit of work. Also, you've got to make sure you surround yourself with the right professionals. You're going to need an experienced mortgage broker, certainly a building inspector, for pest and building inspections, possibly a builder, maybe a financial advisor. And remember, advice that makes you money ends up paying for itself. You want to learn from other people's experiences, not learn from your own experiences, particularly when implementing a strategy like this, as there's so many things that can go wrong. To try and do it all yourself is just too risky. And ultimately, you want to use that stepping stone strategy to get to your desired location as quick as possible and as successfully as possible. And really the only way you're going to do that, if you don't have experience in doing this yourself, is to pay for other people's experiences. Of course, an experienced buyer's agent will help you in this process as well. And the underlying assumption is that we're buying in an area that has upward price momentum. But of course, it's very difficult to predict what markets will do, particularly in the short term. So if the market moves against you, that is a risk also. If the property market has a correction or a crash or just goes sideways, it's going to work against you. But you can only really worry about what you can control, and those sorts of things are highly unpredictable. Of course, I should mention I've done a podcast on family guarantees. So if you're income rich but asset poor, potentially your family can offer you a limited guarantee as additional security for your loan to get you into the property market. So that's kind of a separate alternative to the stepping stone strategy that I've just spoken about. Something that, if it's appropriate in your circumstances, something that's well worth looking into. So just in closing, I acknowledge this is a far more hands-on strategy that won't suit everyone. However, of course, without risk, there cannot be some reward, and without hard work, often there is no reward either. So it might take you a few stepping stones, a few properties to get where you want to be, and a few years in order to get to your desired location. But once you're there, they'll enjoy the benefits for decades to come. I hope that's been useful, particularly for those home buyers or upgraders out there, particularly in a market that is likely to be potentially fast moving this year. If you enjoy the podcast, that is great. And the only favour that I ask you for in return is please share, please tell other people about it. And please leave a rating where you listen to the podcast, whether it's on Apple or wherever, because that gets it out there as well. Thanks very much. And until next week, bye for now.